Hi. If you had two people in front of you that you were thinking about lending money to, and you knew that one had a 620 credit score, had a repossession of their car a couple years ago, and may or may not make their payments on time to the credit card company. And then you have another borrower who has a 780 credit score, has pristine credit, and makes all of their payments on time. Who would you lend the money to? Now, let's say that you had $200,000 and you can give each of them $100,000. Is the risk higher on the one with a lower credit score and who may not make their payments? And if that is the case, would you lend them the money at the same exact interest rate? No? Then how is it possible to answer what is your rate? Hi, and welcome back to another episode of The Mortgage Musketeer, where today I'm going to be talking about one of the most common questions that I get. What is your rate? And then how difficult is that to actually answer without an explanation? So it is probably one of the most misinformed questions that I get. And what I want to do today is actually show you why. Because the rates actually work in a band and there's risk factors. Depending on credit score, how much you're putting down, a lot of different factors that go in there. And that's going to determine what the actual rate is. So to have a blanket statement of what is your rate, that's not an easy question just to answer. Let's take a look at the computer and I'll show you why. All right, so this is a 30-year conforming rate, and I just used a 3-month. What this is depicting is 35% of the loans locked in the nation, and it is giving you actual loans, like interest rates where they were locked at. Now this is just kind of where the rate was at, right? So this gives you a general idea of what is happening in the market. And we already talked about in my last video about how rates went up and why they went up, and feel free to go take a look at that video. But more importantly, the question is, well, if we're trying to answer what is your rate, there's a lot more that goes into it. So first of all, what type of loan is it? Is it a regular conventional loan? Is it an FHA loan? Is it a VA loan? Is it a USDA loan? All of them have different rates. So what type of borrower are we dealing with? You know, you can see that they run across the board. Okay, but let's just start with conventional, because that's what most people are thinking about and say, hey, what's your rate? Well, there's a couple other things that we have to consider. So what is the loan to value? Is it less than 80%? Or is the loan to value greater than 80%? In other words, are they putting 20% down or more? Or are they putting less than 20% down? And that will show you, hey, if they're putting 20% down or more, they get a slightly better interest rate. If they are putting less, it's a slightly higher interest rate. Now, how does that go? You see that it works in 20 bucket increments. All right, this is the FICO score. So FICO score greater than a 740, FICO score greater than 740, but not putting 20% down. Okay, so now we've got different buckets. So if we sit there and look at, depending on what their credit score is, how much they're putting down, we got spaghetti soup here. Okay, so you tell me, what is the rate? So you can see how difficult it is, the band. Here is your rate. Well, it's anywhere from, looks like locks nationwide were anywhere between a 3.749 and a 4.254. Were there some less than that or higher than that throughout the nation? Yeah, you bet. But this gives you an idea that it's not that simple. Okay, now let's throw in FHA, VA, and USDA. And how in the world are you going to be able to tell what the interest rate is? On an FHA, most of the time, they are looking at, they're not putting 20% down. And usually an FHA loan, they're sitting here with less than a 680 credit score. Now, if they don't have a lot of money to put down, sometimes you end up here, right? And then credit score or interest rates are lower. right? But every one of these is different. Very rarely will you get an FHA loan where they're putting more than 20% down. Same thing with the VA. Very rarely will you get 20% down or more. Okay, and on a conforming conventional, they might be putting less than 80% or less than 20% down, but very rarely are you going to be below a 680. And then you can see what happens to the credit score if it is between a 680 and a 699. Okay, then the interest rate is typically much higher. If it's between 700 and 719, again. So this is why you need to understand that just that simple question of, hey, what is your rate, is not that simple. The better question is a response saying, I don't know, what is your borrower's qualifications? Because that's what's going to tell the tale. Okay, and this was on February 4th. This was nationwide. Okay, tells the tale, but it's a big old band. The next time your loan officer calls or a buyer calls or somebody calls you and says, hey, what's your rate? Now you know that is not really a very informed question. A better question would be, hey, I'm about ready to put down 5% on my loan. I have a 723 credit score and I'm trying to figure out what are your conventional rates. Okay, and that we can actually figure out. But you just say, hey, what are your rates as a blanket? Then you're going to hear the lender going, well, it's somewhere between here and here, and it sounds like we're waffling, but we're not, because it can be anywhere in there. Now, this is where it really gets tricky. If you ever get a loan officer who says, you say, what are your rates? And say, oh, yeah, we're at like a 3.25. They're throwing a rate out there. Your online lenders do this all the time. They just throw it out there because it's like fishing. Oh, they got you. And then they say, well, your credit score is this. Well, you're putting this down. The next thing you know, you're at 4 something. Or they will give you that 3.25. Absolutely, I'll give you that 3.25. But what they don't tell you is that it's going to cost you money. Those are points. They're going to charge the crud out of you to get down to that 3.25 because what you did is you came at them and said, what is your rate? Okay? And that is not the question that you need to be asking. The question you need to be asking is, where do I, as a borrower, qualify, and what would my rate be with these parameters? And this is also why people ask, what interest rate is it? And a loan officer might say, well, it's impossible for me to tell until I pull your credit, because you can see how the different buckets work. All right? I hope this helps helps you understand what we're talking about with rates. It's just not that simple. And it gives you a better perspective of the market and how it's an actual band based off of many factors. If you have any questions, I'd love to hear about it. Leave comments below. Please like, subscribe, share this with anybody that you think might find it useful. And until next time, it's all for one and one for all.